The modern technology sector operates at blistering speeds. Billions of dollars flow through global networks every second, creating massive, rapid price swings that day traders rely on to extract profit. The NASDAQ 100 index aggregates this exact volatility. It tracks the largest non-financial companies, meaning every breakthrough in artificial intelligence and every massive quarterly earnings report drives the entire index up or down. But you cannot buy an index directly. An index is purely a mathematical calculation. To actually capture these rapid price swings, you have to use a specific financial instrument that tracks it. For day traders, this forces a choice between two completely different vehicles: the traditional QQQ exchange-traded fund or the NAS100 contract for difference, commonly called a CFD. An ETF acts like a basket of stocks you trade on a public exchange, while a CFD is a direct agreement with a broker to exchange the difference in an asset's price from the moment a contract is opened until it is closed. These operate as completely separate structural frameworks. Deciding between QQQ and NAS100 isn't about predicting the market. It's about matching instrument mechanics to your constraints. Select the wrong framework for your account size or schedule, and you mathematically guarantee failure before trading. Long-term survival in this market requires you to know exactly how your chosen instrument functions behind the scenes. We have to look at market hours first. This is a rigid boundary placed directly on your capital. The QQQ ETF is strictly chained to standard U.S. stock market daylight hours. You can trade it primarily from 9:30 a.m. to 4 p.m. Eastern Time. This protects you from having to monitor screens all night. But you are completely locked out when major macroeconomic shocks happen overseas while you sleep. The NAS100 CFD operates differently. As a derivative contract, it trades nearly 24 hours a day, 5 days a week. This allows you to instantly enter positions when breaking news hits Asian or European markets, long before Wall Street wakes up. This chart shows midnight news impact. The NAS100 CFD reacts smoothly as global traders price in information. The QQQ remains frozen. At the U.S. Open, the CFD has stabilized, but the QQQ violently gaps down, trapping overnight traders with immediate losses. The right choice depends on your availability. You either need an instrument that fits your 9 to 5, or you need the flexibility to trade whenever the global market moves. The other major dividing line between retail traders and professionals is capital efficiency. Trading the QQQ relies on standard margin. For U.S. day traders, this caps out at 4-to-1 leverage, meaning you need tens of thousands of dollars in actual cash to generate meaningful daily returns. Without significant leverage, a small trading account is restrictive. Your buying power is heavily constrained by the physical cash sitting in your account. The NAS100 CFD takes the opposite approach. It utilizes high leverage, allowing you to control massive market exposure with a fraction of the capital. CFD leverage mechanically magnifies capital. A $2,000 deposit controls a $180,000 position. Capturing profits on that full value means a 1% upward move generates $1,800. Conversely, a 1% drop instantly annihilates your balance. This mathematical danger is why reputable CFD brokers implement negative balance protection. This automated safety mechanism forcefully closes losing trades to ensure you never owe the broker more money than you originally deposited. To survive this extreme volatility, professionals adhere to a strict math equation. They use position sizing to ensure they never risk more than 1% of their total account capital on any single trade. Leverage is a volatile accelerant. It demands flawless, emotion-free risk management to keep a bad trade from destroying your portfolio. Once you select your structural framework, you have to execute trades on the chart. The most reliable method for the NASDAQ 100 is trend following. You identify the sustained direction the index is moving and use moving average indicators to enter trades riding that momentum. Mean reversion is the aggressive counter-strategy. It assumes extreme price spikes will eventually snap back to their historical average, allowing traders to capture quick profits. But betting against a powerful, news-driven trend in the tech sector is extraordinarily dangerous. You are positioning yourself directly in front of massive institutional momentum. And even if your chart setup is flawless, technical analysis is immediately overwritten by major macroeconomic data releases. Metrics like the Consumer Price Index, which measures inflation, and the Federal Reserve's decisions on interest rates dictate monetary policy. When these numbers drop, they force the entire index to reprice itself in milliseconds. These policy decisions are made by human authorities. A single sentence at a press conference triggers massive index-wide price swings, completely ignoring your moving averages. A perfectly executed chart strategy fails if you remain blind to the global economic calendar. There is no objectively perfect instrument to trade the tech sector. You have to audit your own personal resources. First, look at the traditionalist. This is a trader who has abundant starting capital, operates easily during standard U.S. daylight hours, and prioritizes a strictly regulated, lower leverage environment. This chart maps out exactly what that trader needs. Based on their high capital and fixed schedule, their requirements perfectly align with the standard QQQ ETF. Then there is the agile optimizer. This trader has limited starting cash, needs to trade during irregular evening or overnight hours, and maintains ironclad emotional discipline. That specific combination of constraints maps directly to the highly leveraged, nearly 24-hour framework of the NAS100 CFD. Regardless of where you fall on this chart, your ultimate filter for profitability is your psychological resilience. You have to follow a strict written trading plan to survive the drawdowns. Test your chosen framework in a simulated, risk-free demo account. Learn how the leverage and the hours actually impact your decision-making before you commit real money. The market does not care about your ambition. Long-term victory belongs exclusively to the traders who accurately assess their own limitations and deliberately select the instrument built for their reality.